Every time you receive a paycheck, a significant portion of your earnings vanishes before you even have the chance to hold it in your hands. You check your pay stub, note the deductions for federal income tax, and accept it as an immutable law of nature, a bureaucratic routine as old as the nation itself. But the system of universal federal income tax withholding, the mechanism where your employer is legally compelled to act as the government's frontline tax collector, was not standardized until 1943. For most of American history, the idea that a corporation would preemptively seize a worker's wages on behalf of the Treasury was considered politically unthinkable and administratively impossible. Why does your boss take the money first? This is not merely a question of accounting convenience. It is the story of a profound transformation in state power, a calculated psychological and economic architectural shift designed to turn the American public into the involuntary, continuous financiers of a global superpower. To understand how the government gained first access to your labor, we must look back to an era when the federal government survived on tariffs and the income tax was a radical, highly localized experiment. In the 19th century, the relationship between the average American citizen and the federal government's treasury was distant, mediated primarily through indirect consumption. The government funded its operations through customs duties on imported goods and excise taxes on specific domestic products, most notably whiskey and tobacco. You paid your taxes at the general store or the seaport, baked into the price of a bottle of rum or a yard of English wool. Direct taxation of income was an emergency measure, deployed only when the survival of the state was directly threatened. During the Civil War, Abraham Lincoln and the Republican Congress enacted the Revenue Act of 1862, introducing a progressive income tax to fund the Union war effort. It was a crude, temporary instrument. Citizens were expected to calculate their own obligations and submit payment directly. There was no vast bureaucratic machinery to verify incomes, and certainly no mechanism to extract the money before it reached the taxpayer's pocket. When the war ended and the immediate fiscal crisis subsided, the tax was allowed to expire in 1872. The federal government retreated to its traditional reliance on tariffs, and the American worker's paycheck remained entirely their own. However, as the Gilded Age accelerated, the economic landscape of the United States fractured. Industrialization created unprecedented concentrations of wealth, while agrarian workers and urban laborers faced severe economic instability. The tariff system, which disproportionately burdened the working class by raising the cost of basic consumer goods, fueled deep populist resentment. The demand for a permanent income tax emerged not from bureaucrats seeking to control wages, but from social reformers and agrarian populists who wanted to redistribute the tax burden onto the newly minted industrial millionaires. When Congress passed a flat 2% tax on high incomes in 1894, the Supreme Court swiftly struck it down the following year, declaring it an unconstitutional direct tax. The reformers realized that to tax income permanently, they had to alter the foundational blueprint of the country. The result was the 16th Amendment, ratified in 1913, which granted Congress the power to lay and collect taxes on incomes, from whatever source derived, without apportionment among the several states. Yet the system created in 1913 looked nothing like the system you navigate today. It was explicitly designed as a class tax, not a mass tax. The exemption thresholds were set so high that only the wealthiest 1% of Americans owed anything at all. If you were a factory worker, a farmer, or a clerk, the income tax was a distant phenomenon, a penalty levied on bankers and railroad tycoons. For those wealthy few who did owe taxes, the payment process was remarkably different from modern withholding. It was a lump sum system. Taxpayers assessed their income for the previous year and wrote a single check to the Treasury on March 15th. They had the money in their bank accounts, they earned interest on it throughout the year, and they felt the acute, painful reality of handing over a massive sum of capital all at once. The government acted as a creditor, waiting patiently for its citizens to settle their debts in the spring. This system functioned adequately when the taxpayer base was small, wealthy, and generally possessed the liquidity to write a large check once a year. But this fragile, gentlemanly arrangement of retroactive lump sum collection harbored a fatal flaw, one that would be brutally exposed when the ambitions of the state suddenly expanded, requiring not just the wealth of the elite, but the continuous, systemic extraction of wages from the entire working population. The fatal flaw of retroactive tax collection remained dormant as long as the federal government's financial needs were relatively contained. When the United States entered the First World War in 1917, Congress passed a new Revenue Act to fund the military buildup. Exemptions were lowered, dragging a larger segment of the middle class into the tax net for the first time. Yet the Treasury hesitated to fundamentally alter how the money was collected. They instituted a system of information at the source, requiring employers to report the wages of their workers to the government, creating the bureaucratic ancestor of the modern W-2 form. But they stopped short of demanding collection at the source. Corporate leaders lobbied fiercely against becoming unpaid tax collectors for the state, arguing the administrative burden would cripple American industry. The government acquiesced. For the time being, the American worker retained control over their gross wages, and the ritual of the March 15th lump sum payment survived. Following the armistice, the conservative fiscal policies of the 1920s, spearheaded by Treasury Secretary Andrew Mellon, rolled back the wartime tax expansions. The income tax reverted to a specialized levy on the wealthy, but the illusion of permanent prosperity shattered with the stock market crash of 1929 and the subsequent Great Depression. As corporate profits evaporated and high-income fortunes collapsed, federal tax revenues plummeted. President Franklin D. Roosevelt's New Deal required immense capital to fund its unprecedented array of public works and relief programs. To finance this expanding administrative state, the government needed a broader, more stable revenue stream, one less vulnerable to the volatile fortunes of the financial elite. The critical architectural shift, the precursor to modern income tax withholding, arrived not through the income tax itself, but through the Social Security Act of 1935. To fund the new system of old-age pensions, the Roosevelt administration introduced the payroll tax. This was a radical departure in American civic mechanics. For the first time on a mass national scale, the federal government legally mandated that employers deduct a specific percentage from their employees' paychecks before the wages were dispersed. The money was transferred directly to the Treasury. The justification was framed around social welfare, a forced contribution to a personal retirement trust, which made the bitter pill of wage seizure palatable to the American public. But beneath the rhetoric of social insurance, a profound institutional precedent had been set. The federal government had successfully conscripted the private sector payroll department into a decentralized arm of the Treasury. The psychological conditioning of the American worker had begun. They were learning to accept a permanent discrepancy between the money they earned and the money they were permitted to take home. This newly established mechanism lay waiting as global stability deteriorated. By 1939, as mechanized warfare engulfed Europe, the United States found itself dangerously underarmed. The Roosevelt administration recognized that preparing the nation for a potential two-ocean war would require industrial and financial mobilization on a scale never before attempted in human history. The wealth of the top 1%, even if taxed at confiscatory rates, was mathematically insufficient to build the arsenal of democracy. The federal government needed the aggregate wealth of the American working class. Through a series of aggressive legislative maneuvers, culminating in the Revenue Acts of 1940 and 1941, Congress drastically lowered personal exemption levels and simultaneously hiked tax rates. Almost overnight, the income tax was transformed from a class tax into a mass tax. Millions of factory workers, mechanics, clerks, and farmers who had never filed a tax return in their lives were suddenly legally obligated to pay a portion of their income to fund the looming war effort. But the Treasury Department was staring down a catastrophic fiscal time bomb. The tax system was still operating on the archaic, lump sum, retroactive model. A factory worker earning a modest wage in 1941 would not owe their newly expanded tax bill until March 15th of 1942. Government economists realized a terrifying truth. The working-class American did not have the financial margins of a Gilded Age industrialist. They lived paycheck to paycheck. They would not, and mathematically could not, save a large portion of their weekly wages for a massive tax bill due the following spring. If the government waited until March to collect the funds required to build tanks and battleships, they would face mass involuntary default. Millions of citizens would simply not have the money. The state required a continuous, guaranteed flow of capital to fund the war machine, and the old gentlemanly system of retroactive collection was steering the American economy toward a monumental crisis. The Treasury was staring into an administrative abyss. By early 1942, as the first wave of newly minted working-class taxpayers scrambled to file their returns, the delinquency rates began to climb. The federal government was simultaneously trying to fund a two-front global war and acting as a massive, unsecured creditor to millions of citizens who possessed no liquid savings. The traditional architecture of American taxation was breaking down under the stress of total mobilization. The solution to this existential fiscal crisis did not emerge from a government bureaucrat, but from the private sector, specifically from the mind of a corporate retail executive. Beardsley Ruml was the chairman of the Federal Reserve Bank of New York, but more importantly, he was the treasurer of R.H. Macy & Company, the massive department store chain. Ruml possessed a deep, practical understanding of consumer psychology and working-class cash flow. He had observed a recurring tragedy among Macy's employees. When a senior worker retired, they stopped receiving a paycheck, but they still owed the federal government a massive lump sum tax payment for their previous year of employment. The retroactive tax system routinely bankrupted men and women the moment they stopped working. Ruml recognized that the American worker was chronically in debt to the state, operating on a one-year delay. If this dynamic was crushing individual retirees during peacetime, Ruml calculated it would collapse the entire national economy during wartime. His proposed solution was brilliantly simple in its accounting, yet radically invasive in its application. He called it the pay-as-you-go plan. Ruml argued that the federal government must abandon the retroactive lump sum model entirely. Instead, utilizing the payroll deduction mechanism pioneered by the Social Security Act, the government should mandate that all employers deduct estimated income taxes from every worker's paycheck every single week before the wages were ever distributed. However, Ruml's elegant architectural fix slammed into a massive political wall. To transition the entire nation to a pay-as-you-go system in 1943 meant that citizens would suddenly have their current wages seized for 1943 taxes, while still legally owing the government their massive lump sum payment for 1942. It was double taxation in a single calendar year, a financial burden that would instantly bankrupt the American middle class. To make the system work, Ruml proposed something that horrified the Treasury Department. The government would simply have to forgive the entire 1942 tax debt. President Roosevelt and Treasury Secretary Henry Morgenthau Jr. vehemently opposed the Ruml plan. They viewed it as a massive, unwarranted bailout for the wealthiest Americans, who would suddenly see their massive 1942 tax obligations wiped clean by legislative fiat. The debate raged in Congress for months. Populist Democrats attacked the forgiveness clause as a giveaway to war profiteers, while pragmatists argued that without forgiveness, the transition to withholding was mathematically impossible. The war effort, however, cared little for ideological purity. The Treasury was bleeding capital, and the military required immediate, continuous funding. The deadlock was finally broken by a heavily negotiated compromise, the Current Tax Payment Act of 1943. Signed into law on June 9th of that year, the legislation fundamentally rewired the economic relationship between the citizen, the employer, and the state. The government agreed to forgive 75% of the 1942 tax liability for most Americans, amortizing the remaining 25% over the next 2 years. In exchange for this partial amnesty, the state secured the ultimate prize. Beginning on July 1st, 1943, universal federal income tax withholding became the law of the land. Every employer in the United States was conscripted into service as an unpaid agent of the Internal Revenue Service. The psychological impact was immediate and profound. The pain of taxation was surgically altered. Instead of the acute, agonizing experience of writing a massive check every March, the extraction of wealth became a dull, continuous, almost invisible ache. By taking the money before it ever reached the worker's hands, the government essentially eliminated the concept of the taxpayer as a debtor making a conscious payment, replacing it with a system where the state simply claimed its share of the nation's labor at the source. To ensure compliance and manage public outrage, the Treasury launched a massive propaganda campaign, enlisting Walt Disney to produce animated shorts featuring Donald Duck, framing the new withholding system as a patriotic duty to defeat the Axis powers. The American public, focused on the survival of the free world, accepted the new architecture as a necessary wartime emergency measure. The Current Tax Payment Act of 1943 was sold to the American public with an implicit, unwritten promise. This was an emergency measure, a temporary sacrifice necessary to win the Second World War. But the architects of the American administrative state quickly realized that Beardsley-Rummel's pay-as-you-go mechanism was far too valuable to dismantle once the Axis powers surrendered. When the war ended in 1945, the vast military-industrial complex did not vanish. It transitioned into the permanent mobilization of the Cold War. The federal government had grown accustomed to a massive, uninterrupted river of revenue, and the traditional, gentlemanly system of retroactive tax collection was permanently relegated to the ash heap of history. The consequences of this permanent shift were profound, creating clear winners and losers in the new economic architecture of the United States. The undeniable victor was the federal Treasury. By severing the psychological connection between the act of earning money and the act of paying taxes, the government eliminated the friction that typically restrains state expansion. If the Treasury had to ask citizens to write a check for 30% of their income every March, the political backlash would force strict fiscal discipline. But by taking the money first, in small, continuous, almost imperceptible slices, the state engineered a system of passive compliance. The losers were, and continue to be, the American employers and the American workers, though in vastly different ways. Private businesses, from massive corporations to small family enterprises, were permanently conscripted into the federal bureaucracy. They bore, and still bear, the immense administrative and financial burden of calculating, deducting, and transferring the government's revenue, functioning as unpaid compliance officers under threat of severe legal penalties. For the American worker, the loss was psychological and structural. The withholding system successfully conditioned generations of citizens to view their net pay as their actual income, effectively blinding them to the true cost of the state. This psychological triumph culminated in the modern phenomenon of the tax refund. Because employers typically over-withhold to ensure compliance, millions of Americans receive a check from the Treasury every spring. Instead of recognizing this as the return of an interest-free loan they were legally compelled to provide to the government, the system has successfully trained the public to view the refund as a windfall, a benevolent gift from the state. This raises a crucial question about the mechanics of modern civic life. Does the undeniable convenience of an automatic deduction outweigh the loss of direct financial control? Or has the American worker been fundamentally conditioned to celebrate the return of their own confiscated labor? The legacy of 1943 is not merely a change in accounting procedures. It is the foundational architecture of modern federal power. Without the withholding system, the vast scale of the current United States government, its military, its social safety nets, its regulatory agencies, would be fiscally impossible to maintain. Your boss takes the money first because, in the crucible of a global war, the state realized that the only way to fund an empire was to ensure the citizen never truly held their wealth in the first place. To continue uncovering the hidden historical architecture that dictates the systems of your daily life, subscribe to our channel.